Welcome to a new deep dive. Today we're taking a really fascinating look under the hood of a well-known investment fund. You've sent us these recent letters from the CEO of the Fundsmith Equity Fund, and they give a pretty candid look at their performance, their strategy for 2024.
Absolutely. And our mission today really is to unpack these insights, not just for what they tell us about Fundsmith specifically, but what they reveal more broadly about navigating today's, dynamic investment landscape.
Right.
We'll look at how they performed, what drove those results, and crucially, how their core investment philosophy is holding up, especially with big trends like, the AI boom and the rise of index funds.
Yeah.
Think of this as your shortcut to understanding the thinking behind a major active investment approach.
Okay, let's dive right in then. The early indicators, looking at the first half of 2024, Fundsmith was up a solid 9.3%.
Pretty decent, yeah.
But here's where it gets really interesting. The MSCI World Index, which is their main comparison point, actually did better. It returned 12.7%.
Yeah.
So, 9.3% in half a year is generally pretty good, aligns with long-term averages. Why might that feel like underperformance in this context?
Well, the critical point they highlight, and it's a big one, is just how heavily concentrated market returns were in that period.
Okay.
If you look at the S&P 500 index, for instance, just 5 companies, Amazon, Apple, Meta, Microsoft, and NVIDIA, they were responsible for a staggering 46% of the returns.
Wow, almost half from just 5 stocks.
Exactly. And NVIDIA alone, that contributed 25%, a quarter of the index's entire return. It was an incredibly narrow market.
And Fundsmith, they own 3 of those 5, right?
Yeah.
Apple, Meta, Microsoft.
That's right. Though, as they noted, their Apple stake was kept small. They were waiting for a better price, basically.
Okay.
And crucially, they didn't own any NVIDIA. They felt its outlook wasn't predictable enough for their criteria.
So without having that full Fab 5 exposure, I guess outperforming was always going to be difficult then.
Very difficult in that specific period, yes. Without those huge boosts, especially from NVIDIA, keeping up with the index was a massive challenge.
Makes sense.
But on the positive side, their own top 5 contributors for that first half were still strong names. Novo Nordisk gave them a 3.4% boost, Meta Platforms 2.7%, Microsoft 2.0%, Alphabet 1.0%, and Stryker 0.8%.
So still getting good performance from their core holdings.
Definitely. It shows the underlying strength. But then, conversely, the biggest detractors included names like L'Oreal, which lost 0.7%, IDEXX down 0.6%, Nike also down 0.6%, Brown-Forman, Nizer 0.5%, and Waters, Niga's 0.5%.
And those were often down to specific things like fewer vet visits affecting IDEXX or China's economy hitting L'Oreal.
Exactly. Specific company or sector issues rather than a broad problem with their picks necessarily. Things like, the post-pandemic drop in vet visits or economic headwinds in China.
Okay, so that paints the picture for the first half. What about the full calendar year 2024? How did it all net out?
Well, looking at the full year, the Fundsmith Equity Fund ended up 8.9%.
Okay,
8.9%.
Yeah,
But again, compared to a much stronger 20.8% for the MSCI World Index. So purely on that annual number, it does look like, significant underperformance.
yeah, that's quite a gap for the year.
It is. But this is where, the fund really doubles down on its long-term perspective. They constantly emphasize this isn't about one year.
Right, the bigger picture.
Exactly. Since they started back in November 2010, the fund has returned, cumulatively, 607.3%. That's 14.8% per year.
Which is impressive.
It is. And importantly, it's 2.7 percentage points more per year than the MSCI World Index's 12.1% annualized return over the same period.
So long-term, they're still ahead.
Significantly. And what's also fascinating, I think, is their Sortino ratio. It's a measure of risk-adjusted return, but it importantly only penalizes the downside volatility, the bad kind of risk.
Okay, how does that look?
The fund's Sortino is 0.87 compared to the index's 0.60. That suggests they've delivered about 45% more return per unit of that harmful downside volatility.
So smoother ride, potentially less stressful for investors than just tracking the market roller coaster.
That's the implication, yes. Consistent returns without quite as much of the painful drawdown risk.
That long-term view is definitely key. And it's worth remembering this fund is actually the second best performer since it launched in its whole peer group, the Investment Association Global Sector. That's out of 162 funds.
Yeah, returning 353 percentage points more than the sector average. It's a standout long-term record.
And yet you can see how, for investors, just looking at that 2024 number, It must have been a test of patience, right?
Absolutely, no question. And the challenge in 2024, it was really just a continuation of the first half story, that extreme concentration of returns.
Same names driving
Pretty
things.
much the same Fab Five:
Yeah.
NVIDIA, Apple, Meta, Microsoft, Amazon. They provided 45% of the S&P 500's returns for the full year. NVIDIA alone was responsible for over 20%.
Still NVIDIA dominating.
Hugely. And it wasn't just a US thing either. They pointed out SAP in Germany provided 41% of the DAX index's returns. Very narrow leadership globally.
Okay, let's dig into some of the individual stock stories for the full year then, especially those surprising detractors. What happened there?
Well, take L'Oreal. It's a long-term favorite for them, but it got hit by China's struggling economy. Still, the fund sees it as fundamentally sound, a long-term hold.
Okay.
IDEC-X, the veterinary diagnostics company, yeah, it suffered from fewer vet visits after the pandemic boom. But again, Fundsmith is holding on, believing in its industry leadership and the long-term growth in pet care.
Makes sense. What about Nike?
Nike, which they actually bought during the pandemic, faced some issues. Management, they felt, was overlooking traditional retail, relying maybe too much on fashion trends. But there's a new CEO, so maybe some hope for a turnaround there.
And Brown-Forman, the Jack Daniels maker.
Yeah, they saw consumption fall a bit. And interestingly, they noted early signs that weight loss drugs might be impacting alcohol consumption pattern.
Ah, that's a big theme potentially.
It is. It actually led them to sell their position in Diageo, another spirits company. But they kept Brown-Forman partly because of its premium positioning and strong family control, which they value for long-term thinking.
Okay, and maybe the most surprising detractor you mentioned was Novo Nordisk. Leader in weight loss drugs, growing revenues, but the stock price fell 10%. How does that happen?
It seems counterintuitive, doesn't it? Especially when its main competitor, Eli Lilly, trades at double the PE ratio. The fund essentially views this as a valuation issue, maybe market pessimism getting ahead of fundamentals, rather than a problem with the actual business.
So they think the market's got it wrong on Novo's valuation.
That seems to be their take, yeah. Meanwhile, on the plus side, Meta and Microsoft just kept delivering strong performance. Meta was a top contributor for the fourth time, Microsoft for the ninth.
Wow, real consistency there.
Absolutely. Philip Morris also did well, continuing to benefit from its big shift into reduced-risk products. That's been a really powerful, ongoing story.
Right, the heated tobacco and vaping side.
Exactly. And automatic data processing, ADP, they call its performance, metronomic, just consistently good, not flashy, but a real compounding machine. And Stryker, the medical device company, benefited from that backlog of elective surgeries clearing after the pandemic.
It's interesting, though, they have that mantra, you make money with old friends. But several of those old friends, L'Oreal, IDEC-X, Novo Nordisk, were actually detractors this year.
That's a great point.
They seem to see it as just a blip, planning to hold because these companies are simply too good to sell. But, I mean, how do you really tell a blip from a genuine long-term problem that should make you sell? That must be incredibly difficult.
It really gets to the core challenge of active management, doesn't it? Judging whether it's just market noise or if the underlying story has fundamentally changed, they're betting on the long-term quality shining through.
Which brings us neatly to their actual investment strategy.
Exactly, their philosophy.
Right. So given that performance context, what's the actual blueprint here? Let's break down their investment strategy. It seems surprisingly simple on the surface.
Yeah.
3 steps. First, buy good companies. How exactly do they define good?
They use what they call a look-through basis. Essentially, they analyze the whole portfolio of companies as if it were one single business.
Okay, interesting approach.
And what really stands out when they do this is how much better their portfolio companies perform compared to broad market indices like the FTSE 100 or S&P 500 on key financial metrics.
Like what specifically?
Well, for example, in 2024, their companies averaged a 32% return on capital employed, ROCE. Compare that to just 16-17% for the indices.
That's a huge difference. Double.
It is. And operating margins, too, 30% for their companies versus 15-16% for the indices. These high returns, high margins, they're particularly valuable when inflation is high, as it shows the companies have pricing power and allocate capital really well.
Got it. And they also look for growth, right? You mentioned free cash flow grew 14%.
They do. But here's a really crucial insight they shared. Their cash conversion has been lagging a bit.
Cash conversion, what does that mean exactly?
It's basically the percentage of reported profit that actually turns into real spendable cash for the company. In 2024, it fell to 85%.
So for every dollar of profit, only 85 cents showed up as cash. Why is that significant?
It can be a signal that growth is requiring a lot of reinvestment, maybe more than usual. It's definitely something investors should watch. The fund attributes this dip primarily to a big jump in capital spending at just a few companies,
Which ones?
mainly Alphabet, Microsoft, and Meta, who are all pouring billions into AI capacity, things like GPU chips and data centers. And also Novo Nordisk, which spent a massive euro billion buying manufacturing sites for its weight loss drugs.
Okay, so big investments happening.
Yep. Huge investments. Now, with Novo Nordisk, they're building capacity to meet demand that already clearly exists. But for the AI spending, the fund themselves say it's still an open question whether this sort of arms race between the tech giants will actually generate adequate profits and returns to justify the immense cost.
So some caution there on the AI spending payoff.
A little bit, yes. It's also just remarkable, as an aside, that the average founding year of the companies in their portfolio is 1920. They're collectively over a century old, on average. Speaks to that enduring quality they look for.
Wow, 1920. Okay, step 2. Don't overpay. How do they judge valuation, especially for these good companies that presumably deserve a premium?
They primarily look at the weighted average free cash flow yield, FCF yield. At the end of 2024, their portfolio's FCF yield was 3.1%.
And how does that compare?
Well, the median FCF yield for the S&P 500 was higher, at 3.7%. But Fundsmith argues that since their companies are fundamentally better businesses, higher returns, better margins, you'd expect them to trade at a lower yield, meaning a higher valuation.
Okay, so the lower yield reflects the higher quality.
That's the idea. And they actually anticipate this gap might narrow a bit in 2025 if that cash conversion number improves, which would boost the free cash flow generation.
Right, and the final step, which sounds so easy, do nothing. What does that practically mean for an active fund manager?
It fundamentally means keeping portfolio turnover incredibly low. In 2024, their turnover was just 3.2%, barely any trading. Tiny. And what's really insightful here, I think, is their focus on the total cost of investment, the TCI. They emphasize this over the more common metric, the ongoing charges figure, or OCF.
Okay, why the focus on TCI?
Because TCI includes all the costs, including the cost of actually buying and selling shares, which the OCF often leaves out. While their OCF was 1.04%, pretty standard, their TCI was only slightly higher at 1.05%.
So almost no hidden trading costs because they trade so little.
Exactly. It highlights their commitment to truly long-term holding. They mentioned 4 companies they've held since the fund started in 2010, 9 held for over 10 years, 15 for over 5 years.
Real buy and hold investors.
Definitely. And their point is, if you only look at OCF, you could be missing significant costs, dragging down your returns in funds that trade a lot more frequently. TCI gives you the honest picture.
That's a really important distinction. Okay, let's look at some specific moves in 2024. Why did they actually sell some companies?
Well, they sold Diageo, which they'd held for a long time. They cited issues with new management and problems in its Latin American business, which was really underperforming.
And the weight loss drug concern.
Yes, that too. They voiced a broader worry that maybe the whole drink sector could face headwinds from these drugs changing consumption habits.
Interesting. What else?
They sold McCormick, the spice company. They felt it was too slow in passing on higher input costs to customers and was facing more competition from supermarket-owned brands, basically losing some of its pricing power.
Okay. And Apple. They sold that too.
They did. Now, they initially bought Apple when its PE ratio was lower, but the share price ran up strongly, even though sales growth was pretty sluggish, only 2% last year.
Right.
So it just got too expensive for them to justify adding more, violating that don't overpay rule. So they exited the position.
Makes sense according to their philosophy.
Yeah.
So what new companies did they bring in that did meet their criteria?
They started building positions in 2 new names. First, Atlas Copco. It's a Swedish industrial company.
Okay, what's special about them?
They're known for outsourcing a lot of their manufacturing, which makes them very capital light. They also have highly decentralized operations and, importantly, a major controlling shareholder, the Wallenberg family, which Fundsmith likes for promoting long-term decision-making.
Fix their quality and long-term focus.
Precisely. The other new purchase was Texas Instruments.
The semiconductor company.
Yep, they make analog and embedded microprocessors, essential components in lots of electronics. Texas Instruments has a history of investing heavily before demand picks up, positioning them well for cycles. And they're also a big beneficiary of the trend towards onshoring semiconductor manufacturing, which reduces geopolitical risk, another factor Fundsmith considers.
So very deliberate additions that fit the mold.
Very much so.
Okay, let's shift gears a bit and talk about some broader market themes they addressed. The AI boom, obviously, is still huge. They spend quite a bit of time comparing it to the dot-com era. Is history repeating itself here?
Well, they use that classic Mark Twain quote, history doesn't repeat itself, but it often rhymes.
Right.
So yes, there's definitely hype around AI, no question. But they highlight two really key differences compared to the dot-com boom back in the late 90s.
Okay, what are they?
First, the leading company in this AI boom, NVIDIA, is actually very profitable. Hugely profitable. Many of the dot-com darlings, you remember, had no profits at all, just eyeballs and promises.
Good point. Big difference.
And second, and this is maybe even more significant, is the massive role of passive or index funds today.
Ah, the rise of the trackers.
Exactly.
Yeah.
In late 2023, passive investments actually overtook active funds for the first time ever. They now make up over half of all assets under management, AUM. Back during the dot-com boom, passive was tiny, maybe only about 10% of the market.
Wow, over half now. So how do these index funds, especially the ones weighted by market cap, actually change how the market behaves?
Well, what's really striking, and Fundsmith points this out, is that these big market cap weighted index funds, just by how they're built, they essentially act as a momentum strategy.
How so?
Well, as money flows into these index funds and huge amounts are flowing in, the largest chunk automatically goes to buy shares of the largest companies in the index.
The ones that are already big because their shares have done well.
Exactly. So it creates this self-reinforcing feedback loop. Money comes in, buys the winners, pushes their prices higher, makes them an even bigger part of the index, which attracts the next wave of index money. The big just keep getting bigger, potentially beyond what fundamentals might justify.
That makes sense. It sounds like it could build up quite a bit of concentration. But what are the vulnerabilities then? What happens if that momentum stalls or reverses?
That's the crucial question. The fund points out that if we saw an economic downturn serious enough to cause a significant cutback in tech spending, and tech spending is so huge now, it's hard to argue it's completely non-cyclical anymore.
Right.
Then AI spending could be particularly vulnerable, mainly because it's not actually generating substantial revenues for most companies yet. It's still mostly cost.
So it could be the first thing cut in a downturn.
Potentially, yes. And if these largest companies, the ones driving the index upwards, were to disappoint on earnings or outlook, their share prices could react very badly.
And because they're such a big part of the index.
Exactly. They would drag the whole index down much more severely than perhaps active managers like Fundsmith, who have deliberately chosen to be underweight in these super concentrated, potentially overvalued stocks.
So the index structure itself creates a potential source of amplified downside risk if the leaders falter.
That's the argument they're making, yes.
Okay, one last area of volatility. The fund has a quite distinct view on this, especially thinking about a stock like NVIDIA, which they don't own, but which famously fell, what, over 2/3 in 2021, 2022?
Yeah, a huge drop back then before its massive rebound. Fundsmith argues that we should think about true volatility not just in terms of share price swings, which can be wild and sometimes irrational, but in terms of changes in the underlying fundamental value of the businesses.
Easier said than done to ignore big price drops, though. Right?
Oh, absolutely.
Yeah.
It's incredibly hard psychologically to stay calm when a stock price plummets. They actually compare the situation to Meta's stock price fall in 2021, 2022, a 76% drop, which they did hold through.
Right, they rode that one out.
They did. But they draw some important distinctions between Meta then and NVIDIA now.
Like what?
Well, first, Meta serves billions of consumers and millions of advertisers, a very broad, diverse customer base. NVIDIA's demand, on the other hand, is dominated by a tiny handful of hyperscalers, those giant cloud computing companies, much more concentrated customer risk.
Okay, customer base difference.
Second, NVIDIA supplies capital goods. The chips are investments for its customers. A downturn in demand from those few big clients could mean orders just stop, dry up completely. That's generally more dangerous for a supplier than a gradual downturn in consumer spending that a company like Meta might face.
Right, capital spending cycles can be brutal.
They can. And finally, the valuation point again. Meta was trading at about 28 times earnings before its big fall. NVIDIA, even after its incredible run, is currently on about 54 times earnings, a much higher starting valuation, suggesting potentially less margin for error.
So different risk profiles,
Yeah.
even if both experience volatility.
Very different in their view. Ultimately, the fund's aim isn't to shoot the lights out every year by chasing the hottest stocks. It's explicitly stated to produce a high likelihood of a satisfactory return over the long run, rather than chasing spectacular returns that might also come with the risk of spectacular losses.
A focus on consistency and avoiding big mistakes, it sounds like.
That seems to be the core philosophy, yes. High quality, don't overpay, and then have the patience to let compounding work.
Well, we've certainly covered a lot there. We've navigated through the Fundsmith Equity Funds year, looking at the numbers, the specific stock stories, unpacking their investment philosophy, and touching on these huge market themes like AI and index funds. You've really given us, and you, the listener, an insider's view of how one prominent active manager thinks through the challenges and opportunities, especially in a market like 2024's, which was so dominated by just a few names.
It really has been a fascinating look, and it leaves us, I think, with a really interesting question to ponder for your own long-term thinking.
Go on.
Well, given Fundsmith's strong emphasis on buying good companies with predictable outlooks, based often on decades of history, how might the incredibly rapid evolution of AI, something they're clearly investing in through companies like Microsoft and Meta, but also watching quite cautiously, how might AI reshape the very definition of what makes a company good and predictably profitable in the decades ahead?
That's a big one.
It is. It potentially challenges the nature of long-term, quality-focused investing in a world that feels like it's changing faster than ever, something to definitely keep thinking about.